Hello, everyone. We are from Princess Sumaya University for Technology of Jordan, and today we present our hold recommendation for Nutridar. Our team has determined a target price of 1.07 JDs, which represents a 3.4% upside from the closing price of 1.03 as of May 4th. Nutridar was founded in 1994 in Jordan as the first and only local manufacturer of infant formula and nutrition products. It operates as a subsidiary of Dar al-Dawa, which owns 90.42% of the company. The majority shareholder, Dar al-Dawa, is considered one of the leading pharmaceutical companies in Jordan and the MENA region, with strong regional sales and experts across international markets. Nutridar exports to several countries, including Iraq, Syria, and Algeria, which approximately accounts to 48% of total sales. In addition, Nutridar follows a diversified sourcing strategy, importing its raw materials mainly from France and Saudi Arabia. Our recommendation is based on weighing the growth potential of the company against its limitations. Nutridar has resilient but moderate growth, recently improved profitability and debt management, and operates in a defensive industry with inelastic demand. With limitations including geopolitical risks, it's a company with thinly traded stocks and ESG weaknesses. As for the industry analysis, the infant formula market is expected to grow at a compound annual growth rate of 5.14%, with key demand drivers including urbanization, rising female labor force participation, and growth of e-commerce. However, key constraints include declining birth rates and strict regulations and safety requirements. Moving on to competitive positioning, Nutridar holds 25% market share in Jordan, competing against global multinationals such as Nestle, Danone, Abbott, as well as Al Mara'i as a regional competitor. In Iraq and Algeria, there is strong demand due to high birth rates. However, competition is increasing due to new local production. In Syria, the market is shaped by currency weakness and conflict. However, it is driven by affordability and availability, favoring mid-priced brands.
Continuing with ESG and starting with environmental practices, Nutridar has partnered up with specialized firms to recycle manufacturing waste and office paper, in addition to ensuring the safe transport of hazardous material. Furthermore, they have also invested in renewable energy solutions by establishing solar panels. On the social side, the company demonstrates strong social responsibility through multiple initiatives, such as the blood donation campaign and hosting free medical days in pharmacies and schools. In addition to that, they invest heavily in training programs and offer training opportunities to university students. Furthermore, Nutridar's website contains information about child health and nutrition to ensure knowledge transfer and social development. About its corporate governance and emphasizing on the red flags of the company, Nutridar's board of directors consists of 6 male members. All are non-executive, however, 5 are non-independent. This is further incorporated in the committees, as both the governance committee and the nomination and remuneration committee consist of entirely non-independent members, in addition to the audit committee, which consists of 2 non-independent members out of 3. Another notable observation is the lack of disclosures, especially a dividend policy and a conflict of interest policy. Nutridar has scored a 6.5 on the Sustainability Code and a 7.1 on the Corporate Governance Code, arriving at an average score of a 6.8. This was reflected in our valuation by adding a zero point 0.8 ESG risk premium to the cost of equity. We have benchmarked Nutridar against peers, Nestle and Al Mara'i, using MSCI and Bloomberg General Guidelines to identify areas of limitation. Key points were the lack of disclosures, the lack of science-based targets, the lack of diversity, and finally, the lack of reporting on the SDGs. To conclude, although Nutridar aligns with peers by obtaining international certifications, they fall behind on ESG transparency and some practices, as they have scored moderately on the ESG international scoring methodologies.
As for our financial analysis, we found that Nutridar's historical revenue performance was mainly driven by their local sales in Jordan. But sales growth was hindered in 2020 and 2021 due to COVID-19 implications such as the lockdown. Moving forward, our forecast suggests a growth of 9%, similar to that of their historical revenue performance, but with a different sales mix, where sales growth will be driven by their successful entry into the African market, as well as management's desire to expand into more euro based markets, such as Algeria, to reduce foreign currency exchange risks. Diving deeper into performance per segment, our forecast suggests moderate growth in the Levant region, high growth in the African region, as well as moderate growth in the Gulf region. We also analyzed the company's profitability and forecasted that their gross profit margin will decline in 2026 due to the prevailing geopolitical conflicts as well as the rise in input and shipping costs. But beyond 2026, our forecast suggests improvements as Nutridar is able to pass on their costs to their consumers in their more freely priced export markets. And for their EBITDA and net profit margins, we forecast improvements with management's effective cost control and upscaling of operations. For their working capital, our forecast suggests that the company's days, payables, inventory, and sales outstanding will all relatively stabilize in the near future, in agreement with management's long term contracts with their suppliers, as well as their efforts towards tightening their credit policies. With that said, the company's cash conversion cycle is forecasted to reach 65 days in 2025 and 64 days in 2030. We also compared the company's cash conversion cycle to that of peers and found that it is significantly lower. And finally, for their leverage, we found that the company has been reducing their reliance on external financing, as financing costs have reduced by 48% in 2025. With that said, management has not disclosed any growth capex plans for the future and has an underutilization of factory capacity, and therefore, our forecast assumes that they will focus on increasing output and maximizing factory capacity.
Our hold recommendation is supported by multiple factors. Firstly, Nutridar's competitive pricing strategy allows the company to secure market share amongst price-sensitive households. However, this limits its ability to see certain growth opportunities within the industry. Secondly, receivables turnovers have shown continuous improvements, allowing the company to increase internal cash generation and reduce reliance on debt facilities. Moreover, the industry's competitive landscape pressures the company to remain within the value segment. Additionally, the region's geopolitical situation exposes it to potential supply chain disruptions or may even hinder sales in export markets. The recent escalation of conflicts within the region between the US and Israel with Iran heightened such risks. This was reflected in our forecast with expected margin compressions for the year 2026. The stock's low effective free float of less than 10% poses a major liquidity problem. Also, shareholders' return is limited due to accumulated losses restricting dividend distributions.
And now let's dive into the valuation. Our target price of 1.07 JDs was calculated through a blended approach of discounted cash flow and relative valuation. We assign 90% weight to the DCF as it best captures Nutridar's long-term intrinsic value, and 10% relative valuation to incorporate market perspective. Our DCF target price was derived through a 5-year forecasted period, followed by a terminal value calculated using the Gordon growth model. We apply a WACC of 12.4%, with a cost of equity that includes a 2% geopolitical risk premium and 1.5% premium for ESG and illiquidity risks. Our DCF assumptions consider Nutridar's dominant local market position, selective growth across its export markets, better cost management, stable cash conversion cycle, and debt management efforts, alongside a terminal growth rate of 3%, as well as a beta of 0.66. For relative valuation, we benchmarked Nutridar against a peer group consisting of infant milk manufacturing companies, assigning 70% weight to the EV over EBITDA multiple. Overall, relative valuation was used as a supplementary valuation measure, implying a value of 1.02 JDs after applying a 5% discount for illiquidity. To test the robustness of our valuation, we performed a sensitivity analysis varying WACC and terminal growth rate, as well as a Monte Carlo simulation stressing 8 key parameters, where both yielded majority outcomes that fall within a hold. And finally, we performed a bull and bear scenario analysis, considering potential changes in Nutridar's competitive dynamics and geopolitical conditions. And with 9% upside potential versus 10% downside risk, we believe that the stock exhibits a relatively balanced risk-return profile, indicating that it trades near fair value.
Moving on, several potential investment risks were identified. Firstly, escalation of conflict within the region poses a major geopolitical risk. Additionally, global commodity prices fluctuating, along with currency exchange volatility, exposes the company to potential increases in costs. Also, failing to meet standards could lead to product recalls, penalties, or maybe even significant losses. On top of that, the stock's lack of liquidity elevates risk and it contributes to elevated price volatility. And finally, other risks include government price controls and threats of new entrants. Ultimately, we base our hold recommendation on our analysis with our target price of 1.07 Jordanian dinars. Thank you. Questions are welcome.
Okay, my question to you is that the stock is illiquid, is not paying the dividends, and there are no buybacks. Why? And there's no upside. Why would I hold the stock and not sell it today?
I'll be happy to answer that question. So, although the stock is accompanied with several risks, we believe that our hold recommendation is justified because a sell would most likely be overlooking the stock's increasing intrinsic value as well as its defensive positioning. First of all, Nutridar operates within the baby formula industry, which is characterized with inelastic demand. This protects it from any potential economic downsides, and it can be further supported by a beta of less than 1. Also, the industry faces very tight regulatory environment, which acts as a barrier to entry for new competitors, allowing the company to maintain a strong position within the Jordanian market and also increase its sales within its export markets. And finally, regarding the lack of dividends, this is a legal constraint as the company is prohibited from distributing any dividends due to its accumulated losses that it sustained from its exit from the Saudi market. However, when we look at its performance now, we can see that it's significantly improving and cash is piling up due to the lack of dividend distributions. Thus, we believe that the company's value is going to increase due to the strengthening cash position of the company.
Thank you for the good presentation. Very well done. My question is on your financial forecasts. Given that the company operates in several countries that have relatively volatile currencies, and they're also venturing into Africa, which again has the same currency volatility challenges. How did you incorporate that into your forecasts around revenue as well as the equity risk premium of the company? Thank you.
Thank you for your question. I'll be happy to take it. Now, for the company's currencies, the company mainly transacts in three currencies. First, the euro in some of its export markets in Africa, where it sells directly to distributors in the euro, and it also purchases its majority of its raw materials in euro from France. And additionally, it sells in the US dollar in certain markets such as Iraq and Syria, as well as in Jordan, where the Jordanian currency is pegged to the US dollar. Therefore, the main risk involves buying in euro and selling in dollar in certain markets. However, Nutridar is able to hedge against this risk through the following. Excuse me. Okay, so first of all, sorry. So first of all, the company has confirmed agreements with suppliers to purchase at a fixed rate in euro. Additionally, it's expanding into further markets that buy in euro, therefore acting as a natural hedge, such as Algeria and other African markets. And finally, that the Jordanian dinar is pegged to the US dollar, which acts as a structural. Excuse me, that's it from my answer.
Also, I'd like to add that the company has been discussing gaining new contracts with suppliers that sell in the euro to be able to that sell in the dollar, sorry, to be able to sell to euro to the dollar denominated markets.
What do you see as its competitive advantage as a small company in a small market competing against big global multinationals? Like, how does it compete?
Well, first of all, it's the only local manufacturer operating in Jordan. It's relatively closer to the markets that it operates in compared to their competitors. In addition to the fact that they have good procurement models in terms that are based on their relationships with the parent company Dar Dawa.
I'd also like to add that Nutridar
is a low-cost baby formula, which allows it to compete and gain market share within the low-income to middle-income segments within the country.
And I'd also like to add that the company's parent company has strong distribution networks within the region, allowing it to expand into these markets with strong efficiency and effectiveness.
Hi, great presentation. I just want to follow up on the valuation because you have a whole rating and target price is just 3% above current price. Also, your bear and bull case is also within 10% of the target price. So, you know, all the valuation seems very close together and within kind of a certain, standard deviation kind of range. Um, what probability will you give each, bull and bear case uh, in your scenario?
We would assign them relatively equal weights of occurring, and we see that it is likely that both there's equal probability of both occurring, and they do relatively showcase that Nutridar is relatively in a balanced position.
So, what would the company needs to do, or what needs to change for you to make a change in your call from hold to buy or sell?
Thank you for your question. We believe that certain changes in the business fundamentals of Nutridar could change our recommendation from a hold recommendation to a buy recommendation. For example, entering high growth African markets such as Morocco and sustaining the high success as they did in Algeria, in addition to introducing new products and having high sales growth. Furthermore, an important area of focus is the ESG practices, so they can access more ESG sensitive markets such as Europe, for example. Also, they could benefit from economies of scales if they increase their utilization of the factory. And finally, if the conflict in the region subsides, this could improve the valuation.
As for what would make it a sell, if the regional conflicts takes longer period of time, this could affect them badly. Also, if a new aggressive low-cost competitor enters the market and takes a portion of Nutridar's market share in Jordan, also, if Nutridar decides to expand and it fails as it did in Saudi Arabia, it could incur losses.
Did you mention that the parent company holds 93% of the stock?
90.42,
So,
yes.
how would I buy or sell the stock if it is not available in the market?
I'm sorry, can
As
you
a fund manager, do I have the ability to go and buy in the market or sell in the market because it's very liquid stock?
Now, although the company does exhibit some low trading volume, we did analyze the company's trading volume within the last 12 months, and we did benchmark it against some peers in the Jordanian Stock Exchange, and we found that although it could have some effects on the company's price and difficulty for investors to buy or sell the stock without affecting the price. It is still relatively in the moderate range given the Jordanian market. And we did account for this with a additional liquidity risk premium to the cost of equity.
And in terms of the dividends, so you're saying that they're expecting to put it back in place in 29. Could that happen sooner? Like, is there anything with their cash flow that makes it possible that it could happen and surprise people on the upside? And how much could it be? Did you look at that at all?
Well, as of right now, we find that the company is holding on to their cash inside of the company for internal growth. And they haven't disclosed any growth capex plans. And as of currently, they don't distribute dividends. But if they move or recover from their accumulated losses, then they have mentioned that they will start to distribute dividends. But as of right now, we believe that they still have the accumulated losses, and therefore it's probably not going. It's going to take a more longer period of time.
Um, I have a question on the valuation. I think the relative valuations are much lower than DCF. Do you think there is something the market is pricing in that probably is discounting the price that you may not have factored in?
Excuse me, can you repeat your question, please?
The relative valuations are showing that the company is trading at a lower multiple to the rest of the market. I was wondering what the market is pricing in that could potentially be discounting the company, and probably just tying it to the dividend question. If the company is not distributing dividend and is illiquid, how does one then get value as an investor?
So to tackle the first part of your question, a lot of Nichidar's peers are not directly equal peers in terms of the scale they operate in and their business model. Where most peers are more vertically integrated from A to Z, where they own the cow farms and then to the end. While Nichidar purchases the infant formula and then manufactures it into its products, as well as the companies, some of the companies operating in regions where are less affected by the war. This could also benefit their reach, and as well that some of these companies have more access to more profitable markets, and maybe in Europe and what so. And Nutridar is more limited to the Jordanian and nearby countries.
My second question was, if the company is not paying dividend and is relatively illiquid, how do you then realize value as an investor?
The lack of dividends, first, it's because of the accumulated losses. They legally cannot. Because of that, the cash is piling up. And thus, we believe that the intrinsic value or the value of the company is going to improve with cash piling up.
We do believe that in theory, the lack of dividend distribution does not affect the valuation, as whether the cash is being distributed or used for internal growth inside the company. Shouldn't affect the valuation.
Don't you think that if Darul Dawa, yeah, that's right, has 93% stake and this company is operating in many different markets, don't you think this company could be a perfect target for a takeover by Nestle or Almarai or a big giant like that? And that could change this situation.
Now, we do believe that anything is possible. However, given that Dar Dawa is a strategic investor and it has not disclosed any plans to sell its stake in Nutridar, we believe that they are, as they disclosed, that they are holding Nutridar for the long term, and they don't have any plans to exit in the nearby future.
Why do they exit Saudi?
So they exited Saudi Arabia due to having a relatively unprofitable business model back then, where they faced losses given the very high and expensive medical promotion costs. However, moving forward, the company has shifted their business model from a B2C, where they would sell directly to consumers, to now a B2B business model, where they will sell to a distributor and avoid these expensive costs. And management does expect that this will turn in a profitable market for them, given for the forecasted period. And additionally, as well, the price caps for infant formula in major Gulf markets have been lifted recently, and this will also allow for more profitability.
I see that you have added 2% to the cost of equity for geopolitical reasons, added 0.8 to ESG, and 0.7 to liquidity. But then you also add a 5% liquidity discount at the end. So would that be double counting the liquidity?
So the 0.7% liquidity premium to the cost of equity was mainly for the DCF valuation, and the 5% was added because we believe that Nutridar, compared to its peers, is much less liquid, and ignoring this would be overvaluing the company's implied market value. Therefore, we additionally added a 5% to the multiples price. And for the geopolitical risk premium, I'm not sure I understood your question.
Okay, yeah.
Maybe what are you most excited about that could indeed cause the company to outperform your expectations and the market's expectations?
I think it would be their expansion plans to Africa, as the company recently expanded into Algeria and it succeeded a lot. Also, Dar Dawa operates in Algeria, which allows the company to expand further into the African market and potentially succeed as it did in the Algerian market, as it can give it a better distribution network with suppliers and distributors.
In addition to the fact that they have increased their sales by 50% alone from Algeria. And therefore, I believe that this is a very good sign that they are able to enter.
Thank you.